So far we have completed the calculation of liabilities for the fifth problem. We have calculated the capital, a few adjustments still left in reserves and surpluses, and the other schedules under liabilities have been complete. So we got our final figures, which we would be transferring later on one by one to your actual balance sheet as per the schedule numbers. Okay. So next we have is the schedules for the asset side. Schedule 6 onwards is where the assets begin, and we have things like cash balances with RBI, balances with other banks, and all other types of fixed current assets that are given under these schedules. Okay. So again, these were our debit balances, and we have marked these debit balances accordingly, classified them as to which schedule they should go under. We will start with these schedule 6, and we will see what goes under this schedule 6. Okay. So schedule 6 first of all is cash balances that is cash in hand and balances with RBI. Okay. So if you all have noticed, just to give you all a slight differentiation between banking company formats and all these other manufacturing company formats. If you all notice the difference, in manufacturing companies you will see that fixed assets are always written first. You remember that order of liquidity, isn't it? Always fixed assets like plant, premises, building, factory, equipment, all of that goes first, that is your tangible assets. Then will come intangible assets, and then later we write current assets like cash, bank balances, debtors, stock. Current assets are written later in case of your manufacturing companies. Am I right? But in case of banking companies, you will always see that cash comes as the first asset, because cash is the most important asset for a bank. All other things like factory, the premises or the bank, furniture or all these other fixed assets, they are kind of secondary. They are not the most major assets for a bank. So that's the slight difference that we normally notice between these two type of company accounts. So what do we have under schedule 6? We've already marked. We have got cash in hand. Amount for the cash in hand is rupees 240.323. Then next we have cash with RBI, and the amount again that we have is 67.82. Alright, let's total this up. 308.05. Total of schedule 6 is 308.05. Okay, schedule 6 done. Let's do the next one, schedule 7. And schedule 7 is about other banks, balances that the bank has with other banks, and any money at call and short notice. Alright, these are balances, small loans that are given by one bank to another. So what do we have under this? Cash with other banks, first one. Amount is 132.81. Next one is money at call and short notice. $315.18 is the amount. Total this up again, we get the totals or get the final total for schedule 7. Okay. So we'll just highlight it, so later it becomes easier to identify the totals and transfer them. Okay, so this was schedule 7. It's very simple as we go about just adding up all the amounts and classifying them accordingly in the respective schedules. So the major work that you have under these type of problems is only identifying what goes where. Okay, so schedule 8 is investments, and we have already identified which are the investments. We've got gold and government securities. So gold is worth 82.84. Let's not underline this. And we have government securities, which are 365.25. Okay, and the total of this being 448.09. Right. So once again highlight it, and we have the total of schedule 8. Now the next one, let's do schedule 9, and schedule 9 is advances. Right. So for schedule 9 we also have one here. Okay, so just be careful as to not miss out any amount. This is cash credits, which is 1218.15. Alright, then we have current accounts with a debit balance. Okay, and we said current account with a debit balance is overdraft. So what I'll do here is write down overdraft in the bracket. I will just specify, just for your revision later, current account debit balance. Okay, so later when you do your revision, you need to just note down where that amount has come from. Then 42 is the current account balance. Okay, then under advances further you have another one, that is 9, term loans. Term loans, the amount is 1189.32 over here, right? So that's it. We don't have any other adjustments or any other amounts under advances. Let's get the total over here, 2449.47. Okay, done. So that is up to advances. The next one, the next schedule that we have is schedule 10, and schedule 10 is for fixed assets. Now in case of fixed assets, you are also given some adjustments. They're talking about depreciation that is charged on the premises over here. Alright. Now this depreciation is just like an additional information that is given to you. They are not asking you to charge the depreciation. Okay, they're just saying that depreciation has been charged on the premises and furniture. That means these amounts which have been shown here are already after charging the depreciation. Alright, do not minus the depreciation further from these amounts. Okay, they are not talking about depreciation that is to be charged or depreciation that has to be deducted from these amounts. All right, this is the amount or balances of the fixed assets after the depreciation has already been charged. But what we need to do is show that depreciation in our schedule 10, right? We need to show how much depreciation was charged and how we got this final amount. Okay, so we have here schedule 10, fixed assets, and under fixed assets, first one would be premises. We have here premises, and I'll just put it in the inner column. The amount before charging the depreciation. So how will we get that? Before depreciation, I will write it here just for our understanding sake. Before depreciation was 133.55, that is the amount that we got here, alright. This plus how much is the depreciation charged on premises? Depreciation charged on premises was 1,10,000. Okay, and we are doing all the amounts in lakhs. So basically, if you shorten this, it was 1.1 lakh. Correct? 1,10,000 means 1.1 lakh. So this will be 1.10. Okay, and then you get the figure that you had before depreciation was charged, right? So the amount here in the inner column, if you add the two, is 134.65. So what we're basically doing here is, do not get confused at this part. We are not minusing depreciation from these balances which are given. Okay, these balances are after depreciation was already charged. So we are doing a reverse calculation and getting the written down value of the premises before depreciation was charged, right? So you are adding back this depreciation to the 133 to get what was the value before depreciation. Fine. And now from this we are going to show how much depreciation was charged and what was the balance after depreciation. Okay, so less the depreciation 1.10. Alright, this is the depreciation that was charged, and after depreciation we got the actual amount of the premises, which is 133.5. This amount which has been given over here, 133.5. Alright, we are just showing how we arrived at that amount. Same way you have the second one, furniture, and the amount for furniture also before depreciation was calculated. We are going to calculate that. Okay, so furniture before depreciation was equal to the amount given, 95.18, plus how much depreciation did they charge on furniture? 78,000. So we have to reduce this into lakh, correct? So this is 0 lakhs and 78,000. So 0.78, 0.78. Okay, and if you total this up, you get what was the balance before depreciation, and that balance is 95.96. Done. Less, let's show depreciation now. This is just for presentation sake. It doesn't really affect the totals because it remains the same, 133 only, or whatever is given in the balance sheet, it remains the same. But for presentation sake, for showing how much the depreciation was charged during that year, we do this bifurcation and we try to show it separately. So 0.78, deduct it and you get 95.18. Okay, so both depreciations are here and both the amounts or final amounts of premises and furniture are here. So if you total these two up, that is 133 plus 95, you will get 228.73. This is the final total of fixed assets that we are going to take, or schedule 10 that we are going to take to the balance sheet. Is this clear? Okay, and the last one left before we move on to remaining working notes. The last schedule 11. We don't have any items under schedule 11, looks like, right? Under other assets we don't really have anything, so we'll just write it as nil. Other assets, and we don't have any amounts, so this becomes nil. Okay, now other two things that we still need to show. that's another schedule that we have that we need to show is your contingent liabilities. This is schedule 12. Okay, so we still have yet another schedule to go. Schedule 12, contingent liabilities. And under this you have two items we've already discussed the other day. If you look at the problem and the adjustments, these two things, acceptances and endorsements, claims against the bank that are not acknowledged as debts, both of these will go under contingent liabilities. So acceptances and endorsements, and reduce it into the lakh amount and you get 14.12. Course, not to be totaled yet, and we get claims against the bank not acknowledged as debts, and this amount we have already figured out. In lakhs it is 0.55, right? Total contingent liabilities 14.67. Done. All totals done that need to be transferred to the balance sheet. Okay. Any questions so far up to this point?